Economic theory predicts that this ongoing process of crumbling of national economic borders and the associated increase in international flows of capital, goods and services should have resulted into greater pressure towards price equalization and convergence for assets, for commodities and for factors. Given the different speed at which national borders have shrunk, one would expect a greater degree of convergence for asset prices than for goods and factor prices. The available evidence seems to support this contention. While there is ample evidence that assets with similar risk characteristics yield very similarly returns in international financial markets, prices of similar goods and services are still quite different across countries. For instance, many observers have pointed out that long-term real interest rates in major currencies have converged to similar low level, particularly since 2000. Moreover, there has been a large increase in cross-country correlations of these rates, suggesting that these dynamics are driven by a global factor which is quite independent from local developments in real economic growth. Likewise, a simple way to gauge the lack of overall price convergence is to look at the World Bank's latest PPP computations, according to which prices in China and India in 2004 were still on average roughly one half and 1/9 of their dollar counterpart in the United States of America. However, a remarkable development associated with globalization has been that despite the limited convergence in price levels, inflation developments have similarly reflected the influence of global factors. This influence might be due to possible structural effects of globalization on factors affecting global trend inflation, but also cyclical effects of globalization forces, such as the soaring oil price from 1999 up to 2007, may provide part of the explanation. You won't be surprised to hear from a central banker that inflation is ultimately, always and everywhere, a monetary phenomenon, and as such, in the long run, determined by monetary policy. Indeed, the influential observers who have connected the current period of lower and more stable inflation across the world with the workings of globalization have done so by carefully linking it to either its influence on the incentives to engineer an inflationary bias or the emergence of an international consensus on putting price stability centerpiece as the overriding goal of independent central banks. Nevertheless, the forces of globalization may have indeed affected cyclical inflation developments through the following two channels. First, the influence of foreign conditions in the price and wage formation process may have increased because of heightened international competitive pressures, possibly decoupling inflation and standard domestic measures of macroeconomic slack. Second, to the extent that the process of globalization has resulted in a number of terms of trade shocks, attenuated increases in prices of imported manufactured goods, and accentuated increases in commodity and food prices, these may have in turn worked their way into short-term fluctuations in headline inflation. While there is a widespread presumption that through the latter channel, globalization forces have exerted cyclical downward pressures on inflation, it is clear that potentially favorable tailwinds are increasing, turning into contrarian headwinds, posing potentially serious challenges to the maintenance of price stability. This would especially be the case were they to spill over into inflation expectations by the public, leading to possible unanchoring of inflation expectations.